Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 5th of September. Markets remain under the cosh at the moment. At the Federal Reserve meeting last week, Jackson Hole Symposium in Wyoming, the States, an annual meeting of central bankers, the Fed made it quite clear that its number one target was inflation, even if this potentially pushes the US into a recessionary phase. As such, any hopes that inflation might be peaking and perhaps the Fed would ease off the pedal were basically reduced to dust, so that the expected rate hike in September is likely to be another 0.75% increase. Coupled with this, the second largest economy in the world, China, is of course undergoing its own problems. Property sector bubble is under severe pressure, consumer confidence is down, and as a result of a zero tolerance policy on COVID-19, further lockdowns have been announced. So against that backdrop, markets have weakened again. In the year to date, the Dow Jones is now down by 13%, the S&P 500 by 17%, the Nasdaq by 25%, and even the FTSE 100 has now dipped into negative territory and is down by 2.8%. Looking ahead to next week, house builders are in focus. This is a sector, of course, which has been showing strong trading performance but weak share price performance against a basket of worries, including cost of living crisis, even the cladding issue, and obviously the potential for cooling house prices. The first one to report next week is a trading statement from Berkeley Group. These shares have fallen by 34% over the last year. Slightly different Berkeley Group in as much as it has a concentration on London and the South East. Indeed, it's beginning to see some benefit from the opening of the Elizabeth line on the basis of new properties along London and the Thames Valley. At the same time, it's been going through a busy period of acquisitions, and also underlying sales reservations have actually risen by 25%. Nothing wrong with the trading performance there. Similar story for Barratt Developments. We're expecting full year numbers from them. Shares down 44% over the last year. And again, the overarching concerns have very much dampened that share price performance. Last time we heard from them, their completions were up by 4% and indeed greater than pre-pandemic levels. There's an incredible dividend yield on these at the moment of 8% despite its own acquisitions. It's got net cash of £1.1 billion, and of course inflation in terms of house price, average selling prices having increased, is being mitigated somewhat. We've also got a trading statement due from WH Smith, shares down around 9% over the last year. Obviously there's some grounds for optimism here now that travel has pretty much got back to pre-pandemic levels, especially of course as we've been hearing with the airports even overcrowded. And of course WH Smith does very much benefit from its travel locations, not only in airports but also in railways. It's also got a overseas presence, so look out also for any updates on how it's faring in the US and indeed the rest of the world. And let's see also whether its third quarter sales, which were above pre-pandemic levels, have also been maintained. Thank you for watching. Have a great week.